The big risk is, what if you're wrong? Okay, that's what your stops are for. I'm not gonna get on my bandwagon about the stops and all that. I'm just gonna go ahead and finish up this 3-day roll. Okay, here we are at 7 GMT, and we're showing 1.0421, and we see following 1.0411, 1.0407. I got in and executed here at 720. It's 1.0407. And if we look forward on these 10-minute ticks, we can see a little consolidation here around the 9 and 10 GMT hours. We're consolidating around 1.0428 to again 1.0443. The interesting thing is that these numbers are right around that 0436, which was our central pivot for that prior day. So again, it's not that these pivots are predictive. It's not that some prophet came and put them together. It's just that a large amount of institutional traders trade around these numbers, and that hypothesis, or that how would you say, that perception becomes a reality. And you want to trade in a fashion that correlates with the large institutional traders. As a small retail trader, you can't hope to move the market. They're surely going to move the market. So all you have to do is catch a ride on the trend that they create. Okay, here goes our bump right here. We see it at the 11:10 GMT mark, bump starting up. There goes 0467. 11:40 we're at 0473. 11:50 we're at 1.0476. I'd be getting out somewhere around there, and let me point out why I'm getting out there, why I exited that trade there. Because the market began to stall just as quickly as the market moved and bounced rapidly off of that pivot point. The market stalled. And another thing is, because I positioned myself early in the trade at the top of the session, I'm already up more pips than a majority of people who were looking at the central pivots, who were trying to get in once they saw some affirmation, i.e. the market stalling around 9 and 10 around that central pivot point. So you see, I picked up a few more. I probably picked up about 20, 24 more pips. Let's say, depending on how you execute, you could have picked up 20 to 25 more pips just by using the timing that I suggest. And let's look at the chart really fast here. Again, this is just a little basic line chart. Here's where we're entering at 7 GMT. There's that consolidation there you see around the 9 and 10 o'clock hours, and then there's our giant run up as we start to head towards 476, and we begin to consolidate there. I want to point out something else also. We started to consolidate around 476, and if you go back over to our pivot calculator, here's another fascinating thing. We see in our 3-day roll here a central pivot of 1.0478. So again, you're seeing that in a 3-day roll, this is just a good general rule of thumb. You want to be short the market when the market is trading above any number in this 3-day roll, and you generally want to be long the market when the market is trading below any number in this 3-day roll. So again, we were well below 1.0436, and as soon as we got above that 1.0478, everybody had a clue and they decided to go short the market after that little consolidation, and it sold off. So you see there's a lot that you can put together with some basic trader knowledge and just looking at the central pivot points. And that's all I've got for today, guys. I hope you guys are doing well. I hope you guys are out there making some money. And I'm not trying to do this for my health, I'm trying to get you guys educated and trying to keep you guys making money in the markets and trying to make things not so overly complicated. It's not rocket science, people. All you have to do is find out what a majority of traders believe and trade around those assumptions. Visit www.digital-intuition.com and download your free copy of Forex Flows for more informative and entertaining video seminars and podcasts like this one.